Now, we're also talking about how NVIDIA is leading the pack of companies. We're going to switch gears here back to the debt markets and how it pertains to companies, because NVIDIA has earned more interest income than they paid in debt expense. It reported a $359 million interest income for the first quarter, more than enough to cover its quarterly interest expense of $64 million. A lot of math there, but we have the perfect person to break it down. That is Bloomberg's Nina Trentman, who reported on this, joins me now. And of course, we are out of that very busy earnings season, and you are so close to how a lot of these companies think about capital management. What exactly happened with NVIDIA, and is it unique among companies?
Yes, very much. Sort of during the past quarter, what NVIDIA was able to achieve, no one else amongst the companies in the S&P 500 was able to achieve that, given that they not only, as you pointed out, generated way more interest income than they had interest expense on their debt, but they also generated enough to cover their dividend of $98 million, which is unique amongst the companies in the S&P 500.
Why then aren't more companies looking to clip coupons here?
Well, I think, of course, there is a fair amount of companies that are generating way more interest income now with rates being higher than they did before. But then also we are seeing companies spending more on dividends than NVIDIA, for example, even though the company increased or plans to increase its dividend by 150%. Sort of if you look at the amounts that, for example, the Alphabets or the Metas of this world are paying in dividends, what NVIDIA is paying is actually not very much. So it is an achievement by the company's treasury and finance department, but then at the same time, there's also limitations as to how much they pay on dividends.
So what is the outlook then for more short-term investments? If you think that interest rates are going to start decreasing even as early as this year, do you still hold on to cash knowing that it is worth more than it was, say, 5 years ago?
Well, yeah, I guess compared to 5 years ago, certainly so. What we're hearing from Treasury advisors is very much that companies will continue to generate returns in money market funds specifically, and also in other cash-like investments, because the amount that is flowing into these funds is expected to increase as the economy keeps growing. So the expectation is very much that for interest rates, once they decline, that you will still see sort of a better return in money market funds, given that you basically prolong the effect a little bit there.
How much are investors really catching on to this? At the end of the day, where are they wanting companies to put their excess cash?
Well, it depends very much on who you speak with on the investor side. Of course, there are companies that manage money market funds and that are very happy about this, more than $6 trillion in money market funds. And then there's others who manage bond funds who are saying, oh, well, once rates come down, corporate bonds is actually the place for corporate treasurers to put their excess cash. What we're also hearing from treasurers is that they are very risk averse when it comes to corporate cash. So I think probably a fair amount will stay in money market funds, but then also others might move into corporate bonds once rates come down.
A lot of questions about what higher for longer means for a lot of these companies. We're keeping an eye on. Bloomberg's Nina Trentman, thank you so very much for your reporting. Now, coming up, Wall Street's hottest trade is having an ugly moment. We're going to take a look at one firm tied to the world of private credit next. Stick with us. This is Bloomberg.